Aloha, this is Joshua Hayes for the October 20th market wrap for October 21st. Today, the market had a very bullish session with the New York Stock Exchange rallying 5.7%. The NASDAQ rallied a very respective 3.4%. The Dow Jones Industrial Average closed up 4.7%. And the S&P 500 came in with a 4.8% gain. Such bullish action on the indexes is a very good thing to see, but only if it comes on heavier volume. And not only was volume smaller than the day before, it was well below the 50-day volume average. Look at how much below the 50-day volume average, which is the yellow line here, for anybody that actually doesn't know that. It's just ridiculous to see such a large move on lower volume. Well, surely one of the indexes had to have heavier volume, so let's look at the Dow Jones Industrial Average. Nope, lower volume. How about the NASDAQ 100? Nope, volume was below the 50-day volume average there too. What about the NASDAQ? Yep, volume's lower there, and I guess the New York Stock Exchange really sums it up with a 5.7% gain on volume, well below yesterday's total and well below the 50-day volume average. Not only is that the case for this index, but look at all the distribution days in October that led up to the bounce that we're seeing so far. Well, the bounce that we're seeing so far on this very low volume shows you that big institutional funds, the big elephants of the market where you get your big stock movements, not this 1 to 3 day crap that these amateurs keep on talking about. Like, if you're buying stocks now, you obviously have no clue how to buy and hold a 500% gainer, a 1,000% gainer, or God forbid, a 2,000% gainer. I know right now a lot of people watching this will never, ever have the opportunity in their life to ever hold something that large because they simply don't know how to invest right. I got a comment in my silver section from, I guess, subscriber. I don't even know. It could be a free guy or it could be a silver subscriber. I don't know. He was curious as to, do I have any 1 to 3 day plays? Folks, if you're here to trade like that, you might as well leave right now. I'm here to get 500%, 1,000% winners. And when those stocks are not around to get the big, huge gains, I would rather sit on my behind and not do anything. Because eventually, you're going to go play a bounce, and you're going to wake up the next day and being woken up to a negative 25% day. You got to understand, when a stock is below the 50 and 200-day moving average, there is excessive resistance there. Some of your biggest gap downs happen when the stock is already below the 50 and 200-day moving average. Your big gains come after the stock's above the 50 and 200-day moving average. Investors Business Daily and William J. O'Neill has proven this. Going back and looking at the best stocks every year, going back to 1900, we can see that before the biggest moves are made, the stock is already setting up above the 50 and 200-day moving average and breaking out of a nice base. Before the setup actually happens, there is no for sure or higher odds chance that you can get a huge win. It's just like in poker. Sure, you can go all in with 7-2 offsuit, and if you flop 7-7-7-2-2, you're a genius. But guess how often that happens? Your guess is about right, less than 1%. Now, if you've got bullets, pocket aces, it's different going all in than if you were going all in with 7-2 offsuit. Anytime you buy a stock that's not setting up and breaking out of the proper base, you are going all in with 7-2 offsuit. So for that guy that wants to play the 1 to 3 day, I got a nice playoff, this and this, just to let you know, the past month to month and a half to 2 months, I've got shorts with 40% gains, 50% gains, and 60% gains, while you play a 10% bounce here and there. And by the time you sell, you'll probably not be part of this long. You'll probably not be part of the good times anyway. I mean, if you get used to selling your winners for 10, 20% gainers, how are you ever going to be ready to adjust for whenever the big winners do set up and break out? You won't be able to adjust. You'll still be flipping them, and you'll get out of a stock with a 25% gain, and then 9 months later look down the road and see it up 900% and feel like an idiot. So before you think about playing for the 1 to 2 to 3 days bounce, which is completely ignorant, hold your shorts. Continue to hold the shorts where we've got the 30, 40, 50, 60% gains in. Because if it fails at the 50-day moving average and rolls over and goes lower, you're not going to have 30 to 60% gains. You're going to have 50 to 90% gains. And 50 to 90% gains are better than a 10% bounce. So the bottom line is the market's weak. The bounce is on low volume. There's not much to say besides that. Let me also now show you the United States dollar. Look at it today. Another bullish session where it comes well off the lows and manages to close right around the high of the day, near there. Not quite there yet. Let's look at it that way. That looks it clear. So look at all the little tails you see, showing that people bid the stocks off their lows intraday. And look at the open bars all over the place. That's bullish, folks. The United States dollar is bullish. The stock market is not bullish. And for those of you that don't think volume's important whenever you go long a market, you need to study the 2002 lows and the 2003 follow-through day. You'll notice that on the downtrend before the follow-through day, volume is like this below the 50-day volume average on the down days, and then whenever it has up days, it looks like this in September. It doesn't look like what it did in October, and it definitely doesn't look like the low volume rallies that you have now. So this low volume rally in the market is very weak and very lame, and will probably fail at the 50 or 200-day moving average. If it don't, that's all right. I got a new long today. So it broke out of a nice base in a nice pattern, and it's in a bullish sector that's actually doing well in a bad bear market. That long I'm not passing on. I'm going to go long that stock. I'm not going to go long a ton because we're in a bear market. But if we were in a bull market, I would have my first stock to buy a lot of, excuse me. But right now, it's not the time. I got one good long that I can take a poke at. But to get heavily long here while the price of the market is still below the 50 and 200-day moving average is just stupid. It's just silly. Because if you would have listened to the moving averages back in October, you would have avoided the 40% loss in the New York Stock Exchange and S&P 500 that everybody was a part of. And instead of playing a 1 to 3 day bounce, you would have been short stocks the past 2 months, and you would be having around 30 to 40 to 50% gains depending on what short of mine that you took. So for everybody that wants to play 1 to 3 days bounce, you're at the wrong site. Don't forget that James RevShark Depora asked me to partner with him. Tokyo Joe had me feeding him stocks. The big winners, the 1,300 or 2,000% winners, not these little stupid 20% in 2 days, yippee, and then nothing else, or the pump and dump crap that he did. I used to give him the real great looking charts that produced winners, and that's what I've always been able to find my entire life. I've got a new long today, and whenever the market's actually bullish again, I'll be getting very long my pretty beautiful chart patterns, and I'll be buying and I'll be going long, and I'll be staying long as that stock's in an uptrend. And while people flip them because they're playing for 1-2 day bounces, which by the way, how did that work for you in July or March? But remember everybody told me it was a bottom in March? Remember how stupid Joshua Hayes was? They said, oh, don't listen to him, he'll lose you money. Well, in fact, they would have lost you all of your money, and you wouldn't have made any money in the shorts in August or September because you would have been broke if you would have gone long Bear Stearns or Lehman Brothers, like this one nice Wendy Sandy girl hinted that I should do. So I've said it before, and I'm going to say it again. A bull market will come around again. I refuse to call a bull now because the people that are telling me we've hit a bottom, just the fact that those people are telling me that we've hit a bottom is my 100% for sure clue that we haven't probably hit a bottom. Because if these people think that the market's going to move higher, then I definitely want to make sure that I'm bearish on this market. So I'll go long my pretty charts that show up. There's not a whole lot. There's only one, in fact. And I'm going to go long that stock today. And until more show up that are actually more pretty than that chart, I don't plan on being long too many other stocks. So I'm going to go ahead and wrap it up there. This is Joshua Hayes at BigWaveTrading.com. Don't be a permabull. The right side's the bear side until price above the 50 and 200-day moving average, or I start to see a bunch of beautiful chart setups with Max Green Bob, big accumulation, and excellent price pattern. Aloha.